You're listening to Uranium Spotlight on Tuesday, May 7th, 2024. Brought to you by PurePoint Uranium Group, your exploration partner in Canada's Athabasca Basin. PurePoint has commenced a 5,000-meter drill program at Turner Lake, a project surrounded by extensive exploration from industry leaders and on trend with the highest uranium-grade deposit in the world. And now your host, Chris Frostad.
This week on Uranium Spotlight, the Russian ban ignites the spot market and prompts new forecasts. The U.S. continues to look at restarting reactors, and the two largest uranium producers announce Q1 results. The uranium spot price regained $5.50 last week, moving from $87 up to $92.50 per pound U3O8. May kicked off with fervor in the uranium markets, witnessing notable activity in both spot and forward markets. Following the passage of the Russian ban bill in the U.S. Senate, investor sentiment surged, prompting a flurry of transactions. The Sprott Physical Uranium Trust saw its share price rise to a premium, prompting swift cash raisings converted into spot U3O8 purchases. Hedge funds also joined the action, acquiring significant volumes. Last week saw 16 confirmed spot transactions totaling nearly 1.6 million pounds of U3O8, all requiring prompt delivery. Delivery prices within 3 months showed disparities amongst locations, with Cameco at $92, Coverdine at $92.50, and Urano at $92.25 a pound. Term market activity remained subdued, with no new demand or contract awards reported. However, revisions to a non-U.S. utilities request for mid to long-term delivery indicate ongoing evaluations and adjustments in anticipation of market shifts. Last week, the G7 countries made a significant decision to lessen their dependence on Russian uranium. Subsequently, the White House announced potential executive action by President Biden if the Senate failed to pass a ban on Russian uranium, a bill already approved by the House of Representatives in December. Eventually, the Senate did pass the ban, likely to be signed into law by Biden shortly. This ban carries weighty implications for the price of uranium, a crucial mineral. Currently, a quarter of the United States' nuclear fuel comes from Russia, along with an additional 12% of its raw uranium supply. While the ban permits U.S. utilities to continue Russian uranium imports until 2028, there's a looming risk of Russia retaliating by halting all uranium exports to the U.S. These import allowances will be granted to U.S. utilities only if they face supply shortages. Without these waivers, experts like President Jonathan Hintz of UxC foresee a potential 20% spike in uranium fuel prices. Additionally, while the U.S. relies on uranium imports from Uzbekistan and Kazakhstan, there's concern that Russia could pressure its allies to align with its retaliatory measures against the U.S. Dr. Catherine Huff, formerly of the U.S. Department of Energy, assures that the U.S. is prepared for any scenario. Under the new ban, there's a window to establish new conversion and enrichment capacity. Moreover, allies like Canada, Japan, and France are poised to assist, with $2.7 billion earmarked for new enrichment capacity. Huff emphasizes that the U.S. has sufficient stockpiles to weather potential disruptions in Russian uranium exports. Despite the ban's impact on Russia and potential long-term uranium price hikes, the immediate effects on electricity costs or blackout risks are minimal. Reactors operate on refueling cycles spanning 18 to 24 months, with supplies typically procured well in advance. Import restrictions like this serve to revitalize the dormant conversion and enrichment industry in the U.S., said Huff. Senator John Barrasso of Wyoming suggests that domestic uranium production could fill the void left by Russian imports. However, it's essential to note that while Wyoming holds uranium reserves and existing mines, allies like Canada and Australia possess far larger reserves and operational capacities, capable of meeting increased demand. Barrasso's bipartisan legislation aims to redirect funds away from Russian state-owned corporation Rosatom and bolster American uranium production. Consequently, uranium stocks surged in response to this news, with companies like Cameco, NextGen, and Global X Uranium ETF experiencing notable gains. Other uranium miners, including Uranium Energy Corp. And Energy Fuels Inc., also saw their shares rise. The substantial revenue generated by Russia's uranium sales to the U.S. presents a lucrative opportunity for domestic and allied corporations to step in and replace the Russian supplier, potentially reshaping the global uranium market dynamics. Last month, the U.S. made a groundbreaking move to offer $1.5 billion to the owners of the Palisades nuclear power plant in Michigan. What's unique about this deal is that it wasn't to keep the plant running or to construct a new one. Instead, it aimed to restart the plant, which had been closed since 2022 and was subsequently acquired by Holtec Inc. This move has sparked decisions at high levels about the potential restart of other nuclear plants across the country. The rationale behind this is clear. Bringing back offline plants could help tackle the rapidly increasing cost of electricity. In recent years, numerous U.S. reactors were shut down due to a combination of factors, including the rise of cheap natural gas and the expansion of renewable energy sources. However, the landscape is shifting once again. With energy prices on the rise and the emergence of energy-hungry technologies like AI data centers and the electrification of transportation and heavy industry, the United States finds itself in urgent need of additional power generation capacity. Cameco and Kazatomprom, two leading players in the uranium market, recently released their quarterly financial reports, unveiling a mixed bag of results that reflect the current dynamics in the uranium sector. Cameco saw its shares drop by 7% following a disappointing first quarter loss of $7 million, despite a 12% increase in gross profit to $187 million. The company recorded an 8% drop in revenue compared to the same period last year. Adjusted net earnings fell by 51%, largely due to weaker than expected results in uranium and fuel services segments. However, analysts like Alexander Pierce believe that Cameco's lower sales could balance out throughout the year, especially with the recent approval of a Russian uranium ban potentially revitalizing the contracting market. Meanwhile, Kazatomprom reported a 10% increase in production, but a significant decrease in sales, down by more than half compared to the previous year's first quarter. The company's average realized price for uranium concentrate rose by 34% from last year, but was lower than market spot prices, indicating the impact of fixed pricing components in long-term contracts negotiated during previous lower price environments. Both companies' quarters coincided with a notable rise in spot uranium prices, reaching levels not seen in nearly 17 years. Despite challenges, analysts remain optimistic about the sector's future, with expectations of growing positive sentiment towards nuclear energy driving demand growth. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by PurePoint Uranium Group. PurePoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with some of the largest uranium suppliers worldwide. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.